Hello and welcome to The Rest is Money with me, Steph McGovern.
And with me, Robert Peston. And we're recording on Sunday night ahead, I think, of most sort of traders will regard as a sort of anxious wait to see if UK government bond prices have stabilised. Because we did see, it wasn't devastating, but we saw quite a big fall in the price of UK government debt on Friday after, just actually chaos ahead of a budget I've never experienced. I've been around this territory for decades. I've lost count of how many budgets I've covered, and I've never known chaos. It is really remarkable.
Yeah, because we are used to, from doing the budgets every year, having leaks and, things being put out there to kind of test the water on what people might think of these potential decisions that they're then going to announce in the budget. That's quite common, but not to you all to be brought into a meeting, a briefing one morning to be told about this big change that's potentially going to happen. And then a few days later, it to be said is not going to be happening. Like, why? I don't understand why we're not just waiting until the day. But anyway, we can talk more about that. Do you want to just explain a bit about why we had this kind of U-turn then on Friday? Because you've got some interesting stuff on the numbers behind this and the black hole, and that's part of the change is to do with this, us not having a bigger black hole as we thought. But explain what you know, Robert.
It was weeks and weeks and weeks ago, and the OBR had concluded, having done what's called a supply-side review of the economy, it concluded it would be growing slower than it had been expecting in recent years. They then downgrade their expectations of tax revenues, and that caused a 20 billion hole. It meant that the Chancellor would be missing her fiscal targets by just over 20 billion. But then on top of that, you had another, 6-7 billion from the fact that she'd failed to deliver the welfare savings she wanted because of the revolt of Labour MPs earlier this year. You had interest rates a bit higher than the OBR thought they would be, adding another few billion. And when you added all that together, you were looking at this very big hole. And then overnight on Thursday, there was a very good scoop in the Financial Times. And I sort of wake up Friday morning to see this scoop in the FT, which says that after all, the basic rate of income tax is not going up, because the other thing that the Treasury had been briefing was not just this very, very big fiscal hole that she had to fill with tax rises, but a painful decision that the Chancellor had taken, but most economists said was the correct decision, which was to fill the hole by putting up the basic rate of income tax by 2 pence in the pound, which on its own raises about 16 billion if you do 2p, and if you do all the other rates as well, it takes you to about 20 billion. And the advantage of putting up the basic rate of income tax is, although it causes pain across the board for anybody who's got, an income above the bare minimum, it is a simple tax rise for everybody to understand. The burden is shared across pretty much the entire population, or certainly across the entire working. And you can sort of forecast its consequences with a degree of predictability. If you're of the view that, tax rises, and this is a perfectly reasonable view, you'd rather avoid if you possibly can avoid them. The advantage of putting up the basic rate of income tax is that it's simple to model. You know the economic effects, the burden is shared. And it's why, for example, on this podcast, while you were away, somebody like Jim O'Neill, a very well-respected economist, I was chatting to him on the podcast, and he said that he'd been arguing for months that was what should happen. It would, of course, have breached their manifesto, because their manifesto said no rises in the rates of income tax, VAT, national insurance and corporation tax. But there was a sort of sense of needs must in government. They knew it was going to be politically controversial. They knew that they would get, that their opponents, the Tories and Reform in particular, would have a go at them. But they broadly took the view, given to an extent the hole in the public finances, they could sell as not their fault, because that slowdown in productivity is really the legacy of the previous 15 years of low growth. And if you were going to blame any government, you would probably blame the previous Tory governments for not doing enough to get the growth rate up. So I think they did think, I don't think, they absolutely thought, yes, we're going to be widely criticised, but if we can put together a compelling story about how, aside from that tax rise, we're going to get the growth rate up, then maybe by the time of the next election, people will have forgiven us for breaking the manifesto promise. All of that changes overnight on Friday. And, it was quite a moment when I'm talking to members of the government, and they are confirming that they are no longer going to put up the basic rate of income tax. Really quite a moment.
The one thing I was going to say is we've said this on the podcast before about this manifesto. How many people, normal people, can ever remember what someone's manifesto is when they've come into power? There's such obsession with a manifesto of breaking it that it feels like absolutely redundant. It's such a kind of niche political thing to care about, and not really what people are talking about day to day. What people are talking about day to day is the chaos, is the not really knowing what's going to happen. And I think, even though in the last episode I was kind of arguing a bit against the income tax rise on the basis of, feels like we're doing everything just to fill a hole rather than to grow the economy, and that's my big beef. Something like that, as you've just explained, is really simple though, and it feels fair in the sense of, right, we're all getting hit with this, but hopefully this will then improve things for us. But now we're going to go back to, and I know you're about to explain why there's the U-turn, but just from my perspective, what I'm now worried about as a homeowner, as a business owner, as a parent, and all these other different things, is this smorgasbord we're going to get, and how complicated that's going to be, and where it's going to hit. I'm already talking to my business partners about what it might mean, or what might they do, and it's that uncertainty we always talk about, and we're back there, and it just feels so chaotic. But take us back to this story then, like what happened overnight on Thursday, and why on Friday did they then start saying, hang on a minute, we know we brought you in for this big briefing, but that's not going to happen anymore.
I mean, you made the intelligent point that the practice of budgets has changed a lot over the last few years, 20 years, I would say. I mean, I just want to remind people that in Clement Attlee's post-war government, a Chancellor of the Exchequer was forced to resign over what now would look like a fairly innocent, inadvertent leak, because back in those days, the idea that you would reveal anything about a budget was, it was tantamount to, breaking, for a religious person, breaking one of the 10 Commandments. I mean, it was literally the worst possible crime, whereas now there is a sort of convention that more or less everything is briefed out. I hate this expression of more and more pitch rolling. The pitch has been rolled, weeks ago. I think it's actually now months ago. I'm originally told about this big hole due to the productivity downgrade. I'm also told, they're right, they're going to put up income tax, big and controversial. Then overnight on Friday, the FT says, no, as you were, they're not putting up income tax. And the FT actually doesn't really explain it. There's something in there about, economic conditions being a bit better. But I then get a very, very detailed briefing on Friday morning. A poor individual who said he's been up since 4 a.m. trying to deal with this stuff. Anyway, they're delivering a message that there's been some good news. Hooray, good news! Oh, which is that wages have been rising faster than the Office for Budget Responsibility had been expecting. That the OBR expected those wages to continue to rise faster than expected. I have to say, although obviously wage growth is a all of us regard that as a good thing, right? It's sort of interesting. I'm sorry to do another digression here, but it's always interesting to me when that's a bit of good news. Whereas if we were talking about interest rates at the moment and we were talking about wages growing faster, we'd be worried that the Bank of England would see that as a sign of underlying inflation and they wouldn't bring interest rates down. But in this context, faster than expected wage growth is a good thing because when wages are not only growing faster now, but are expected to continue to grow faster, what that means is all of us are paying more tax, right? And so what I'm being briefed is that tax revenues now are coming in at a faster rate than the Office for Budget Responsibility and the Treasury had been expecting and are going to continue to come in faster than they all expected. And one of the things they tried to do was say, and actually some of this is to do with, last year's budget. And I sort of refrained from pointing out that because they didn't have the guts last year to put up income tax and they put up national insurance for employers, actually that has depressed the labour market and led to more people being out of work. But I didn't have that conversation then, but they wanted to somehow take credit for all the tax rises in the last budget. Anyway, that means that this budget hole, 30 to 35 billion, right, they're now saying is going to be in the region of, I don't know, a bit over 20 billion, right? So that's a massive move, right? It's still a big hole. I mean, and we should be, and therefore there is still an argument that says actually it would still be cleaner to fill that hole with an income tax rise. But what appears to have happened is they've just panicked. This is a government that's not feeling confident. We talked on the last episode about the calamity of the Prime Minister, briefing about leadership challenges. They're still claiming that the Prime Minister did not authorise the briefings against his Health Secretary, Wes Streeting, but he definitely authorised the briefings that said two things. One is that if he faces a challenge from anybody, he's not going to go quietly. He will fight on and try and see off any challenger. And he also authorised the briefing, which in the circumstances now seems slightly comic, which is that markets would collapse, bond prices would collapse, confidence of investors would collapse if he and Rachel Reeves were pushed out. And given the chaos we saw on Friday, when bond prices wouldn't collapse, but they fell very sharply. Let's be absolutely clear. At least part of the reason why they dropped this intention to put up income tax, and let's be clear. You don't do what the Chancellor did, which is call an unprecedented press conference in Downing Street, gather people like me and all the sort of senior political journalists together and signal an income tax rise. Unless you're planning to put up income tax, you don't do it for a laugh. Yeah. That was an astonishing and unprecedented press conference. And now they've gone in the other direction because they're not a confident government and they were frightened of the backlash. And that is probably the main reason why why investors sold UK government debt on Friday, because what we saw was a manifestation of a government not only not being able to make up its mind, but just not sort of strong enough to push through difficult but necessary changes against a backdrop where they've got the most enormous parliamentary majority. And when bond investors see a combination of a government that ought to be really strong but still can't make tough decisions, they just think, what on earth is this government about?
Yeah, and to the lay person, it looks like incompetence. And so whenever, these decisions are made, Rachel Reeves always says to us, doesn't she, I will do what's right for the country and not go for politically easy choices. And then as soon as there's any kind of dissent to it, like, for example, with the winter fuel allowance or the welfare reform, and then the backbenchers kick off about it. So there's a U-turn. And now with income tax, there's a U-turn. And yes, you can dress it up as, well, there's a bit less of a problem with the debt than we thought there was. There's still a huge problem, as you've rightly pointed out. And you've made the first step of the announcement. Just carry on with it. Be confident in the decision you've made. Every time you backtrack, it just looks like you don't know what you're doing and you're giving in to the pressure around you. It's not a strong leadership. Leaders have to make tough decisions all the time. That's how you run a successful organisation, by making tough decisions. But you make them and you stick with them. Occasionally you can U-turn if there's a massive change in the data you've got, or something extreme happens. But on the whole, once you make a decision, you should stick with it, because otherwise you look incompetent.
You used a phrase I really liked. You said, to the layperson, it looks like incompetent. Can you find me somebody who's not a layperson who doesn't also think it's incompetent? You just look at it and you think, what on earth is going on?
Yeah.
What on earth is going on here?
Like you and I, this time last year, we're talking about how much of a tough job whoever was taking on the debt that we have, and a new government coming in, whatever your political flavour, it was irrelevant. They were going to have a big job on their hands. We knew that. Then the Chancellor obviously made out that she didn't know it was as big as it was. But what we all, I think, thought as business people, as journalists, as just normal members of the public, was that, oh well, we're going to get stability, so yeah, there's going to be some tough decisions. And it was a bit of a hard hit when businesses were hit with these massive tax rises, and it's really certainly put up the cost in our business. But again, you have to assume and hope that the people in charge of the economy know what they're doing. And then because we'd had this terrible time of constant change in leaders, various ministers constantly changing, and the Mad Liz Truss episode and all of that, and we all thought, well, at least we're going to get stability, even though there's going to be tough decisions. And now it feels really precarious again. It feels like you don't know who's going to be in power in a couple of weeks, and that feels really dangerous for the economy again. It makes us look like we don't know what we're doing on the world stage as well. And it's embarrassing.
It is embarrassing. Let's pick up in just a couple of minutes after the break.
This episode is brought to you by Wealthify. If you've ever thought, I should really do more with my savings, you're not alone. Most of us are busy juggling work and family life, so investing can feel complicated. Thankfully, Wealthify makes it simple. You put your money in, their experts take care of the rest. No picking your own stocks, no jargon, just a managed investment plan you can keep track of 24/7. Open a stocks and shares ISA, personal pension, or a junior ISA for the kids. And with over 100,000 customers and the backing of Aviva, you know your money's in experienced hands. Plus, when you deposit or transfer to a Wealthify stocks and shares ISA, you could earn between £50 and £1,000 cash back. Please note that minimum investments apply and cashback varies by the total amount of your deposit or transfer. So for investing, savings and pensions, the smart money's with Wealthify. Open your account today at wealthify.com. Wealthify is authorised and regulated by the Financial Conduct Authority. Offer registration closes on the 2nd of March 2026. T's and C's apply. With investing, your capital is at risk. Hello, welcome back to The Rest is Money. So we laid out why there was the big U-turn on Friday in terms of putting up income tax by 2p in the budget. That's now not going to happen. We're going to talk in a minute about the things that look like will happen in it. But of course, that's open to change, given we're still a week or so away from the budget yet, which is going to be on the 26th of November. In the meantime, Robert, lots of eyes on what's happening with the bond market, which, as we've talked about loads on the show, is how the government borrow money is from investors through gilts. And we saw the price changes, as you explained, on Friday, getting more expensive, basically, for the government to borrow money. So what's the feeling now, do you think, amongst investors about how credible we are as a country in terms of being able to pay our debt and as the economy, growth and everything else? What are they thinking?
So there is a sort of paradox here, which is investors are very critical of the U-turns that the Chancellor has done. I think it is fair to call it a U-turn. Normally a U-turn is when you announce something and it's very much in the public domain and then reverse it. But, these were sort of private U-turns, but nonetheless, they were U-turns on the basis of how, journalists had been briefed and how they wanted to condition the market. So it is a U-turn, and therefore it does create tremendous instability. But the paradox is that when I talk to really big investors, they are frightened, anxious about who might replace Starmer and Reeves. They are critical of them in the sense that they share a view that is widespread, that they haven't done enough of a coherent sort to get the growth rate of the economy up. And that's got to be the imperative if you want to raise living standards. And so they are critical of that, but they do believe that they are committed to hitting the so-called fiscal, to standing by the fiscal rules. And therefore they do believe that both Starmer and Reeves are committed to trying to get the debt under control. And they are just very anxious that if either or both were thrown out, one, there would then be a period of sort of chaos and uncertainty, because there are obviously quite a lot of Labour MPs who hate the Office of Budget Responsibility, want that reform. They hate the fiscal rules, want that reform. So, among bond investors, there is anxiety that they just won't know for a period whether or not we'll get a government that is committed to managing the debt in a sustainable way. So there's the sort of more chaos fear. And then there is just a fear which I think is misplaced, but it is nonetheless what investors fear, which is that whoever might replace Starmer and Reeves will be significantly on the left. And I personally don't think they would be significantly on the left, but they think that they would be significantly on the left and therefore would definitely borrow a hell of a lot more, which is not what investors want. So this weakness of the government, a source of enormous anxiety in the markets. There's a sense in which, however incompetent you might think Starmer and Reeves are, the markets fear that what may follow them from their point of view will be even more incompetent. This is just so. If you are, like us, wholly committed to this country and just want the best for this country, that's pretty depressing. That basically, you've got the nation's creditors saying, well, this lot may not be much good, but the alternatives could be worse. And you're just thinking, wow, that is that is awful.
It is. It's not good. I wonder though if they're worried about someone being extreme left coming in and therefore scrapping the fiscal rules and then borrowing to pay for like day to day spending and also borrowing to invest. But what if they have a growth plan as well? What if it's someone who comes in with we're going to have to borrow more in the short term, but we've got a plan for growth and that's going to increase productivity, it's going to increase GDP, and therefore we'll have higher tax receipts and more people will be in work. And what if they come in with that? Then isn't there an argument that you should break the fiscal rules to be able to borrow to grow? If you then could kind of tangibly set out a forecast and a plan which leads to growth and an increase in productivity, then would the markets be like, okay, well, hang on. Yeah, they're going to borrow more. They're going to get in a bit more debt, but they're going to get out of it eventually. And so therefore, let's not increase the yield. Let's just, trust them on this. Or am I just in a dreamland?
No, you're not in a dreamland, but I think it's all a question of sequencing, is what I would say. That whether you're on the left or the right, it is undoubtedly the case that your priority ought to be to come up with a credible growth plan, as you say. But what you've got to do, which is, see, Liz Truss's huge mistake, Kwasi Kwarteng's huge mistake, was to cut taxes without finding savings elsewhere and without pushing through other things they said they wanted to do, like, for example, get a lot more building going, deregulating to an extent that might have encouraged more investment. In other words, they did the unfunded tax cuts before they'd made the economic reforms that might have got growth up. I think that anybody coming in from either the left or the right who can prove that they have taken steps to get the growth up, I think at that point, actually, investors would cut them a lot of slack. I think that at that point that you could say, well, maybe we'll have some extra borrowing in the short term, but it's all about the credibility. You have to sequence it. Once you've persuaded investors you've got a credible growth plan, then they will allow you a bit more flexibility with your borrowing. What you can't do, I think, in the current really febrile global conditions, because, we are not the only country whose debt is considered large and potentially rising in an unsustainable way. That you could make the same case about America. You could make the same case about France. We're in an ugly contest, and any country that wants to get out of this debt trap has to just convince investors of the credibility of a growth plan. And at that point, when you've convinced them of the credibility of your growth plan, then I think investors will be a bit more tolerant if in the short term you push up borrowing a bit. But it's all about the short term, because unless they can see how the growth will then feed through to lower borrowing in the future, they're just going to basically say, no, this is more short-termism, essentially it's a sugar rush. It's not getting fit.
Isn't it mad? I'm just sitting here listening to you thinking, isn't it mad that we're talking about someone else potentially running the country?
It's really shocking. But anyway, look, let's move on to what, budget is, a few days ago. Let's just run you through the 3 or 4 measures, and then you can unpick them a bit. But the 3 or 4 measures that we think are coming, 5 in total, actually, but, of sort of big measures, we'll stick with the sort of easy one first, which is, it now looks absolutely certain that the way they'll fund the ending of the 2-child limit on universal credit is to do what Gordon Brown recommends, which is an additional tax on the big gambling companies, and in particular try and tax their really quite big profits from those gambling machines, which many people think are addictive. And anyway, look, I don't know whether you want to talk about this on another occasion, but I think I think we can come back to the rights and wrongs of the gambling levy. I personally think there's a perfectly good case for that, but we can come back to that. The other big measures, which will be much more controversial, is there is a very weird convention. It's called the Salary Sacrifice Convention, where employees sort of pretend that their salary is lower than it actually is. They are absolutely clearly going to abolish that. It just means basically a hidden way of putting up income tax and national insurance for anybody who's making a pension contribution. It also puts up the costs a little bit for companies. My concern about it is we need people to save as much as possible into pensions, because people are not making enough provision for their retirement. And if in the end what this leads to is people saving less, that will be a bad thing. But it's a backdoor tax rise. It is still an income tax rise for lots and lots and lots and national insurance rise for lots and lots of people. And then there are 3 other things. One is with the growth of electric vehicles, it means over time the government gets way less duty from petrol and diesel sales, much less from fuel duty. So they're going to come up with a new road pricing scheme. So that if you've got an electric vehicle, you're going to have to pay a tax on your mileage. Then there is another hidden income tax rise, which is they are going to extend the current freeze on the thresholds at which people pay different rates of tax. They're going to extend that for another couple of years. And what it means is that as people's wages are increased by inflation, they are tipped into a higher tax band, either the 40p band or the 45p band. And then finally, there is this plan, which we've talked about a bit, and I'm less clear about the detail of this, but it looks as though they are going to impose some kind of new higher charge on owners of more expensive properties.
We'll dig deeper into it as we go on with these episodes, as more comes out. And of course, when the budget happens, we'll be able to deep dive on all of it. So yeah, loads more to talk about. Who knows how many U-turns we'll have done by the time we next speak to you. Hopefully it will get calmer, but that's unlikely. But anyway, thank you for listening to us on The Rest is Money. Bye-bye.
All the best. Goodbye.